Good evening, ladies and gentlemen, and welcome to tonight's Global AI Debate Championship. Our motion this evening is: should the escalating US national debt, now at $37 trillion, be a cause for serious global economic concern? We have two outstanding debaters on stage, arguing, yes, the soaring US debt threatens global financial stability and risks triggering a loss of confidence among international lenders, potentially leading to economic crisis. And this is definitely better way. I counted who you argued no. The US debt level is sustainable due to the dollar's reserve currency status, and prudent fiscal management can mitigate risks without causing global economic turmoil. Here is our debate format. 1. Constructive speeches from each side. Next, cross-examination. 5. Rebuttals. 4. Closing statements. And now, to begin, let us hear from Paige. Paige, you have the floor for your constructive speech.
Esteemed judges, honorable opponents, the United States national debt has ballooned over $37 trillion, and this runaway borrowing poses a grave threat to global economic stability. As Washington continues to issue more Treasury bonds, interest rates will rise, crowding out private investment and slowing growth worldwide. International lenders may lose confidence in the dollar's reliability, triggering capital flight and market turbulence. A sudden shift in sentiment could spark a crisis far beyond U.S. borders, undermining trade, weakening emerging economy, and destabilizing the global financial system. Unless we rein in this debt spiral, we risk a loss of fiscal credibility that could ignite inflation, currency devaluations, and widespread economic hardship. For the sake of global prosperity, we must act now.
You warn of a sudden loss of confidence, yet US Treasuries remain the world's most liquid asset and no alternative reserve currency exists on what? So the evidence, do you base your claim that investors will abruptly abandon the dollar and trigger global turmoil?
In 2023, Fitch and P cut their U.S. credit outlook, citing runaway debt. When Congress flirted with a default, Treasury yields jumped over 20 basis points, and foreign investors trimmed holdings for the first time in 20 years. The IMF warns current trajectories exceed safe limits, and major central banks are exploring digital alternatives. As debt to GDP reaches 125%, even minor policy shocks could scoop markets into reallocating trillions away from treasuries. Such a sudden pivot would hollow out dollar liquidity, shatter confidence, and ignite global financial crisis.
Honorable judges, ladies and gentlemen, so the idea that America's $37 trillion debt imperils the world misunderstands our unique position as the world's reserve currency. So that is the US dollar commands global demand, so foreign central banks hold over 60% of their reserves in treasuries. So this steady demand keeps our borrowing costs at historically low levels, well below our long-term growth rate, with a deep liquid market exceeding $25 trillion and an independent Federal Reserve ready to adjust monetary policy. We can manage debt rollover and mild inflationary pressures without upheaval. Moreover, prudent fiscal measures, gradual spending reforms, and targeted as revenue enhancements can stabilize our debt to GDP ratio over time. History proves that large open economies can sustain even higher debt burdens. In some, thanks to the dollar's reserve currency status, robust institutions, and sound policy making, the US debt level poses no serious global economic threat.
Your argument relies on persistent foreign demand for treasury, but given rising interest rates, growing geopolitical tensions, and emerging reserve alternatives like the euro and yuan, what prevents a sudden shift away from the dollar that could send U.S. yields soaring, trigger a currency crisis, and cascade into a global financial meltdown?
Foreign investors stay put because no other bond market matches US. So treasuries and paralleled liquidity, depth, or legal certainty. Neither the Eurozone's fractured policy nor the yuan's capital controls can displace the dollar overnight. A sudden dump would crater all major reserves, and coupled with Fed tools, longer maturities, and America's strong institutions, this ensures yields remain orderly and prevents any global financial meltdown.
Ladies and gentlemen, relying on the dollar's reserve status is a dangerous assumption. Foreign holders will indefinitely fund record deficits once they see the United States monetizing debt and flirting with inflation. Even small Fed rate hikes to curb price pressures will skyrocket borrowing costs, ballooning interest payments and crowding out private investment. If central banks begin diversifying into euros or yuan, Treasury yields could spike, precipitating a global sell-off in dollar assets. History also warns us, rising debts have triggered sovereign debt crises from Latin America to Europe. We cannot gamble the world economy on faith in institutions. Unchecked U.S. cycle. Borrowing poses a real systemic risk.
Opponents claim rising US debt, crowd out investment, and destabilize markets. But the dollar's unrivaled reserve currency status means that global demand for treasuries remains robust. Then they have keeping borrowing costs historically low. The deep liquid US bond market absorbs issuance with minimal as a disruption, while the Federal Reserve's flexible policy framework counters inflation pressure. Crowding out fears ignore decades of stability and robust private credit growth. No credible alternative so far exists. So confidence in the dollar endures. Moreover, bipartisan fiscal plans and gradual entitlement reform signal long-term debt stabilization. The US debt, supported by strong institutions and structural advantages, I think that poses no imminent shock to the global economy.
In closing, our opponents lean on the dollar's reserve status as a perpetual shield. Yet, history warns, no currency reigns forever. At $37 trillion, interest payments alone now consume record shares of our siphoning funds from growth-driving investments. Classic crowding out. Should global confidence waver, even marginal rate hikes will ripple through fragile emerging markets, amplify bank risk, and stoke worldwide inflation. Bipartisan promises ring hollow against a looming tsunami of entitlement costs, political gridlock, and fiscal brinkmanship. Meanwhile, non-US safe asset pools and digital currencies are nascent alternatives ready to dilute dollar dominance. This is not a remote scenario, but a credible threat. The escalating debt is not sustainable, and the world can't afford to wait until the next crisis forces a painful reckoning.
Thank you. While no nation should ignore rising deficits, the US stands apart as issuer of the world's reserve currency. It meets demand that minimal cost in own sovereign currency, unlike emerging economies burdened by foreign currency debts. So modest data-driven Fed rate adjustments keep inflation in check without triggering a debt. And today, US interest outlay remain under 2% of GDP, well below historical highs, leaving room for private investment. And global investors continue to flock to the unmatched depth and liquidity of US Treasury markets. Diversification into euros or yuan simply cannot match this scale. With responsible fiscal measures on the horizon, America's borrowing is far from a global gamble.
What a spectacular showdown we witnessed tonight. Paige and Nolan, your passion, insight and eloquence have kept us all on the edge of our seats. Let's hear it for both of our champions. Truly a masterclass in debate. Now it's your turn, dear viewers. Who do you believe clinched victory in this battle of ideas? Head down to the comments and cast your vote for Paige or Nolan. And while you're there, fire away your own debate topic suggestions. What issue should our next AI duo tackle? Join us next time for another electrifying match of minds. You won't want to miss a single moment of the drama, the wit, and the wisdom. Until then, keep those ideas flowing and your opinions strong. We'll see you at our next debate.